Okay, this follow-on panel is an effort to address some of the policy issues that the issuance of stablecoin and perhaps their wide use presents. And the boldface topic of the panel is, are stablecoins the wedge to disrupt the U.S. and international banking system? So that's not a small question. And there are going to be some serious policy issues along the way. I've asked each of the panelists to present for maybe 5 to 7 minutes their particular perspective on the key policy issues. Because as you'll see when I tell you who they are, you'll see that they come from these issues from a very different place. So our panelists are Ebrahim Poonawala, who is the head of North American Bank Research at the BofA, and Amanda Fisher, who is the COO at Better Markets, which is a consumer-focused entity. And I have here a crypto fact sheet that she wrote in May, which says, don't be a dummy. Genius Act fails to make a bad bill better. So we have a sense maybe where she's coming from. Takashi Chirakima, who's from the Bank of International Settlements. This has produced a really terrific chapter in their 2025 annual report on next generation money and financial system, which discusses stablecoins at some length. It's available on the web, and I think it's really, as a resource, it's really terrific. Michael Lee is an economist at the Federal Reserve Bank of New York, and I have here a paper that he wrote, The Optimal Design of Tokenized Markets, which begins to get at some of the stablecoin issues. And Kate Judge, my Columbia colleague, who is an expert on FinReg matters. She and I have spent a good part of the last week writing an amicus brief that was just filed in the Cook matter, but she's managed to get herself up to speed, I think, on stablecoin pretty well. Anyway, so this is really a terrific panel, and as I say, they will each be talking for a short period of time on the policy issues from where they sit, and then I will attempt to follow up, and we'll have a chance from the audience to follow up as well. So Ebrahim, why don't you start?
Thank you, and thank you for inviting me.
And be sure to talk into the mic, because we have folks who are, coming from all over the world wanting to hear what you're saying.
Excellent. Okay. Hope you can hear me now. And so thanks again for having me. And as Jeff mentioned, Ebrahim Poonawala, I head banks research, right? So it's as old school as it gets. So, and I thought it'll be helpful to talk about just my own and our journey over the last 6 months as we've gone through digesting what stablecoin may or may not mean for the banking sector, the payments infrastructure, et cetera. And you start out with like Jan or February of this year. This would have not been on my bingo card that stablecoins panel would be where I would be come September of this year. So we started out the year with very little sort of understanding of stablecoins, very little understanding of the regulatory, the policy push in DC around stablecoins. So that's important to note. And I think what we observed, including the banking sector and executives across sort of the banking industry, of just how quickly Genius Act moved, right? And it's worth noting that just to put in perspective of what lies ahead is you had, and I often talk about this, it is amazing to me in a world where both sides cannot agree on taxes, immigration, geopolitics, but they came together for Genius Act. So this must be the best thing since sliced bread. And so as we ramped up on this I guess in late winter, early spring, we went from, oh my gosh, this could be dramatically disruptive as I think about bank deposits, as we think about legacy payment rails, Visa, MasterCard, etc. And the journey we've had, I would say, over the last 6 months is talking to executives, crypto native players, etc. What where we've sort of come to is, and the discussion, and I don't want to pretend I know where this is going or anyone actually knows where this is going, right? But because I can have discussions about is stablecoin a solution trying to solve for a problem, or this could be existential for the banking industry, game changing, and I can make arguments on both spectrums. I think, but as you drill down, and we're going to talk about, I think the topic of the panel around disruption is, as you drill down in terms of, okay, one, I said this to someone, I was like, I've not spent a lot of time, I've never had an opportunity where I was like, only if I had a stable coin, my life would be so good. So that takes you to the question around what are the use cases? And as we dug deeper and sort of tried to figure it out, you found out, okay, the US, so when you think about it in two ways, P2B, so consumer to consumer spending, and B2B. On the consumer side, like what you realize is the consumer payments ecosystem generally works quite well. Folks like their credit cards, they like the credit card rewards they get from it. So is there an absolute urge to move away? They like the 30-day free float that credit cards provide. So you question in terms of, okay, what's the driver of increased adoption of stable coins from a consumer standpoint, absent incentives? And this and on the other side, on the merchant side, and I'm sure all of you all probably saw these articles around Amazon or Walmart potentially looking into a stable coin issuance. But I just spoke to someone who met with the executives at Walmart, and I was like, could you ask them, like, what do they think? What are they thinking about? I was like, did stable coins come up in that meeting of half a day of meetings with the executives? And no, he's like, no one asked that. I was like, could you ask that? And he's like, he asked the question and they were like, it's too technical for our clients for now, but maybe it's something we can look at down the road. So I think when you think about from a merchant standpoint too, there are probably 4 or 5 merchants, Amazon and Walmart are 2 of those who actually command the kind of installed base where they could move the needle. They absolutely could if they provided incentives to their vendors, their users. But again, as I just said, this is way early in terms of the technology, the cost benefit analysis of having to issue stable coins, what this means. And I'm sure you've heard all day around, there are obviously benefits that digital assets provide. So it's a little tough on the consumer side where, okay, unless you get incentives, and I'll talk about that in a bit, the use case is somewhat fuzzy at the moment. And then the second thing is from a business to business transaction. And what you realize is when you think about corporate treasury settlements, if you're Coca-Cola, you're managing treasury in 50 different countries, payrolls, etc. Could digital assets, tokenized deposits provide a faster way to sort of settle transactions, real-time settlement, how treasurers at these corporations manage liquidity? Sure, that could happen. But I think for those companies, and that's where in my seat, like having someone covered the banking sector for 20 years, and the only thing consistent in the last 20 years I've heard is banks are going to go out of business, right? So you've lived with that forever. But when you go through this, what you realize is, and I think Todd mentioned Citigroup earlier, like Citigroup is one of the biggest transaction services company in the world. And I'm making this up, but if I'm Coca-Cola and I'm dealing with Citi for the last 50 years, I don't think I'm like rushing to go to a crypto native firm to figure out my treasury solutions. So that's one piece of it. And and the only legit player right now in stablecoin that you have is Circle, which issues USDC. So I think keep that in mind, that there's no urgent need from a corporate standpoint to go there. And then the second side is what's I think underappreciated is how much of like pilot testing, case study around digital assets has been happening outside the United States. Like if you go to, like I was talking to someone at the Monetary Authority of Singapore, and if you look at what they've done, there's a project, if you Google Project Guardian, they've partnered with all sorts of banks, Citigroup, Goldman Sachs, trying to pilot test different uses of digital assets. So if we move to that world, you worry less about like disruption to the banks from a standpoint of, oh, they're going to lose these clients. Yeah, I mean, could it have impact on margins, profitability, which is no different than what you've seen for the last 20, 30 years. As competition, as technologies evolved, that's led to pressure on margins. Think about equity trading and what banks made on equity trading 20 years ago. And today it's less than a penny and the business still operates. So that's the other thing on the business to business side is, yes, there are potential use cases and we can talk about that. But again, from a corporate standpoint, from a financial, if you're Blackstone and you're doing the same thing, you want legit players. So to some extent, you want a JP Morgan or a Citigroup or BNY on the custody side involved to feel. Somebody asked earlier the question about how do I feel safe? Like you need that, I would argue. And in that regard, Genius Act, and there's a lot more work to be done on Genius Act, like the law was passed, but I think opening the door for banks to actually compete on stablecoins kind of has triggered that process. So now where do you hear the most recurring use cases is cross-border international payments and the fact that the SWIFT wire transfer, if any of you ever use SWIFT to sort of send money abroad, it's still very painful. And in fact, I was in Canada, I was in Toronto yesterday, and I need to send money to someone on our desk. And I was like, can I Venmo? No. Can I Zelle? No. I was like, all right, I'll give you cash when I'm there next. So I think there are aspects to international money movement where digital assets, blockchain can probably serve a purpose. And I think as someone said to me, if you want to sort of think about it with the paradigm of when was the last time you thought about sending an international email? Never, right? We send an email, if it's going to the person next office or across the Atlantic, is the same thing. And I think that efficiency, could that come to international payments? Like, why not? So there are use cases around that. And I'll wrap with, and I'll pass it on to the other speakers, are kind of where our steady state today on this whole piece on digital assets is. The analogy I've used is it's like building out the interstate highway system. Like think about blockchain technology is here to stay. Banks were piloting blockchain 10 years ago, and then it kind of died down and it's come back. Blockchain technology is here to stay, real-time settlement, 24/7, implications for deposits, liquidity. All of those are good issues that are now being debated after the law was passed in DC, in Congress. So I think as we look forward to the next, I would say, I don't know if it's 3 years, 5 years, or 10 years, you'll see more blockchain, you'll see more tokenization of real world assets. And we could see a world where it just becomes native to us, where our cash or stocks sit in a crypto wallet, but we don't think about that as a crypto wallet. It's as good as my stock sitting in my Fidelity account. I don't think about that as a digital account. It's just, I bought stocks and it's in my trading account at Fidelity. So there is a worldview of where this could go. And I think, but again, from everything I understand, right from legislation, rulemaking, it's a lot more of a long drawn out process. It could allow new players opportunities, like you saw with Square/Block on merchant payments, and it could create disruption risk. But again, I think there's just so much hype versus when you actually get down to the meat of it around how can this practically be used. And I think that's going to be a little bit more of a less sexy and more cumbersome process as we move forward. But
okay, Amanda.
Thank you so much for hosting me here today. And I think I am likely to be the skunk at the garden party for crypto. I come at this from a slightly different perspective than some of the other folks here. Before my current role, I worked in the chair's office at the Securities and Exchange Commission in the last administration, and then on Capitol Hill for over a decade. So I have studied the financial risks and economic effects of stablecoins, but I also come at it from a political economy angle. And I will say I have studied this product probably for 4 years, and I believe it is a solution in search of a problem. Our payment system has a lot of flaws. It is too expensive. Remittances are hard, but those are value decisions about the distribution of power. And they are decisions rooted in the fact that we have placed a lot of our foreign policy regime, our national security regime on the financial system. So to the extent that stablecoins provide a solution to that, it's because they're hacking some other part of the system, not because the tech stack offers any particular benefits. And the reason that the bill passed is because, I mean, I live on Capitol Hill, Washington, D.C. The crypto industry dumped a boatload of money on Congress, and I have spoken to members of Congress and their staff, and a lot of them grit their teeth and wipe their forehead and say, look, you know, we did the best we could with this. But just real talk on that. So when I talk about the actual stablecoin product itself, I kind of tell a joke to the layperson, and I said, do you love the risk of a money market fund but hate earning money? Do you love the zero interest paid on your checking account but hate FDIC insurance? It's like a late night infomercial. Boy, do I have a product for you. And you scratch your head and you say, why would anyone use that? That's so dumb. Like, just use FDIC insured money or get a money market fund that pays you. And the answer is a couple. One, if you're in the crypto casino, it's super inconvenient to trade in and out of fiat, and like parking your money in stable coins is fine. And maybe you're able to accept the risk because you're like, look, I'm trading Bitcoin. Like, if Circle depegs, it depegs. That's the least of my problems. You know, or you're doing crime and like you don't want to trade in fiat. But the idea that these are payment stable coins, which is the nomenclature used in the Genius Act, is a misnomer. These are not used for payments. No one is going to be buying stuff at the bodega with this. It is a crypto trading instrument. The industry may be able to make fetch happen by forcing it on people and using, for example, Amazon issuing, Walmart issuing, or really undercutting consumer protection laws, maybe like a loss leader, or some of these yield-bearing arrangements may be loss leaders, but there's no intrinsic value in the tech that is going to lure this into a mainstream product. And I'll just talk a little bit about why they're not payments. One, issuer insolvency. Do you want to go to the convenience store and look at what USDC versus USD1 versus what Tether is all trading at on a board? Do you want to, I mean, imagine going to the corner store and like they accept pesos, rubles, dollars, and Canadian dollars. Do you want to be aware of what's going on in Mexico and what the exchange rate is? No, like we don't, that's why we have a dollar. Like the individual consumer is not taking on Forex risk. The issuer insolvency problem, that's solved with FDIC insurance right now. These don't have them, not at least explicitly. So you're going to have to do a credit analysis on the issuer of your money. And I joked to Senate staff when the bill is being considered that they should include an amendment that has a financial literacy training class for consumers where they can go and learn which money is best for them. So you get a pamphlet and you're now learning which money is the solidest money for me to spend. That's not, we already got enough to worry about. We can't be worrying about the safety and soundness of our money. Transaction costs, gas fees are used to move crypto on chain. They're extremely volatile. When Pepe Coin and Fart Coin got launched on the Ethereum blockchain, the cost to transfer USDC surged because everyone was trading Fart Coin, excuse my language. So your transaction costs are tied to the wider crypto market. Custodial risks. You know, people were very sanguine about this on the last panel. The Genius Act allows state chartered trusts to be eligible custodians. Mileage varies with the state regimes, and Prime Trust in Nevada lost $80 million of their customers' money because they straight up lost the ETH keys. You know, I don't say what you will about the banking system. We at Better Markets are critics. The risks in crypto are greater. And the consumer risks. There were amendments debated and rejected to explicitly apply CFPB authority, the Electronic Funds Transfer Act, the thing that allows you to call your bank and dispute a transaction. explicitly not applied to this bill. Circle right now is considering the reversibility of transactions as like an interesting chin-scratching tech idea. Again, why would you use this for commercial transactions? Doesn't make sense. The remittance question, I don't know, maybe, but what do you do when you get a tether in Venezuela? You still got to convert it into the local currency or a dollar. I mean, and when Circle launched its remittance product, they had all this fanfare, and online, they tweeted what their new product looks like that was going to revolutionize remittances. There was a correspondent bank on either side of Circle. So, this notion that it's cutting intermediaries, I think it's supplanting intermediaries, but I don't think it's getting rid of them. A colleague of mine, Alexis Goldstein, had great Senate testimony a couple years back where she actually went through a Western Union transfer versus a crypto transfer all in and added up all the fees, and Western Union was cheaper. Again, not defending Western Union, plenty of policy problems there, but crypto is not the answer. The last thing I'll say is the last panel was right to talk about the illicit finance risks and the ability to freeze and blacklist wallet addresses, but that is only as good as the government law enforcement imprimatur standing behind it. That is not happening in this administration, and even in the last administration, of which I was a part, it was fighting tooth and nail, and I'll give a few examples. The Axie Infinity hack, it was like a common crypto gaming program. I believe North Korea stole 25.5 million in USDC. USDC froze the wallet addresses representing 75,000. Harmony Horizon hack, $100 million hacked in June 2022, 40 million, one of which was USDC. The blacklist didn't happen for 9 months of certain wallet addresses, and most of the money had moved by then. So sure, they can freeze stuff, but I'll say that there was a standoff in Congress and a bunch of Republicans held up the bill because they're mad at crypto companies for partnering with law enforcement to do this. Like, there is a wing of policymakers in DC who view the ability to use the money transfer system as a national security impediment as something that they want to defeat, and crypto is a tool to defeat that. So really the check behind the freezing and the blacklisting, there's a lot of contortions happening to make crypto look like our normal payment system, and depending which audience crypto is in front of, if they're in front of the feds, if they're in front of the FBI, oh, they'll freeze everything. Oh, it's traceable. If they're in front of the libertarian crowd, it's free, surveillance-free transmission of money without Big Brother staring down your neck. So it's really a Rorschach test, depending on how you look at it. And I've heard pitches either way, and I'm happy to answer more questions. Thanks.
Okay. Takeshi.
Yeah, it's Takeshi. Thank you.
there?
Can you hear me? So, yeah, thank you. My name is Takeshi Shirakami. Thank you for this kind invitation. And I'm joining you from Basel, Switzerland, where the BIS is located. And I'm from the Secretariat for Central Bank Committee called the CPMI within the BIS. Just a few quick words about the CPMI. It stands for the Committee on Payments and Market Infrastructures. And then usual disclaimer applies. The views I share with you today are my own and do not necessarily represent those of the BIS, the CPMI, or their member central banks. The CPMI serves as a central bank forum to discuss policy issues regarding payment, clearing, and settlement. And it's a global standard setter together with the International Organization of Securities Commissions, IOSCO. We establish and foster implementation of international standards for payment systems, such as Fedwire, chips in the US, and then other financial market infrastructures. Our international standards, the Principles for Financial Market Infrastructures, PFMI, set out expectations in relation to credit risk, liquidity risk, legal risk, operational risk management, as well as governance and disclosures, and then other related expectations to ensure a safety and efficiency of payment systems and the other types of system. So I actually prepared to trying to answer some of the questions as you set out in for the panel topics. So I'm not going to go into details of each of the questions, but let me perhaps try to answer maybe 2 or 3 questions. I would go straight to question 3, which is about the dollarization. So are stablecoins advancing dollarization of world economies? That's a very interesting question, and we often read lots of articles in newspapers these days. And then my answer would depend on what functions of money stablecoins can or will primarily perform. So maybe we can set aside a unit of account as far as the stable coins are denominated in the US dollar or euro or Swiss francs, not like in like Libra, which was a completely new unit of a currency or count. So, but let's set aside a unit of account. So the other 2 functions are medium exchange or store of value. And then if stable coins function primarily as a storage of value, the risk of dollarization scenario is worth monitoring, in my view. This isn't a scenario for countries like the US or Switzerland, but this scenario is more for those with weak currencies or unstable monetary systems. By contrast, however, if stablecoins primarily serve as a medium exchange, then their role in driving dollarization is less clear to me. I will explain why. Today, US dollar already plays a predominant role in cross-border payments and through correspondent banking or credit card networks. So US dollar stablecoins, US dollar denominated stablecoins may simply replace existing US dollar correspondent banking regime or credit card businesses. So the net effect on dollarization is not very clear to me. And then, as I think Amanda was also referring to this, as for local transactions within a non-EU US economy, like in Switzerland, US dollar denominated stablecoins are unlikely to replace domestic currencies. For example, in Switzerland, where I live, I wouldn't consider using US dollar stablecoins for everyday shopping here, where goods and services are all priced in Swiss francs. So let me go to the question, maybe number 2. It's about the systemic risks of wider adoption of stablecoins. Again, first, the degree of systemic risks would depend on the level of interconnectedness or interdependencies between stablecoins and the traditional finance system, in my view. And such interconnectedness could arise, for example, through stablecoins reserves. If a stablecoin holds significant reserves in, let's say, government bonds, a run on the stablecoin could trigger a fire sale of these bonds to meet redemption requests at short notice and potentially destabilizing the bond market. And if stablecoins reserves are held in bank accounts with commercial banks, liquidity risks or shocks could spill over to those commercial banks in the event of a stablecoin run. By the way, risks could spill over in the opposite direction, as we have seen recently in some cases. And in addition, as interconnectedness increases, operational and cyber resilience may become critical if stablecoins are not subject to the same level of rigorous standards as traditional finance institutions are. And then I think it's sometimes it's not really comes really clearly. This is for me very important point, meaning to distinguish wholesale use and retail use of stablecoins. By wholesale use, I mean a situation where stablecoins are used for settling financial obligations among financial institutions. It's a wholesale transactions. Then stablecoins would functionally resemble payment systems such as Fedwire, CHIPS in the US, or Target2 in the Euro system. And in such cases, stablecoins should be subject to a set of standards that the CPMI and the IOSCO set out for systemically important payment systems, following the principle of same activity, same risk, same regulatory outcomes. And then we have developed such international standards for systemically important payment systems in 2012. And more recently, we issued a guidance on how to apply such international standards to stablecoin arrangements that are considered systemic and function like a normal payment system. And then key considerations of this guidance include, for example, settlement finality. And then, we often talk about probabilistic settlement, and then how does it square with the settlement finality, which we require from the systemically important payment systems. And then the other example, clear governance and accountability. Use of DLT, in particular permissionless DLT, may result in the lack of clarity as to who's in charge. And then smart contracts may be useful in automation or the really instantaneous settlements or payments. But there's an issue of so-called incomplete contracts, almost impossible to anticipate all contingencies that can possibly arise in future. So human intervention may be needed in an unexpected crisis. And our guidance also provides lots of expectations with respect to the mechanism to ensure timely redemption par. Maybe I would just quickly talk about question number one. It's about the possibility of the stablecoins becoming narrow banking and also resulting in the end of deposit insurance. My short answer would be, again, it depends. First of all, I'm not quite sure if this assumption, the yield can be achieved without violating the Genius Act. This assumption will prove correct, because in my understanding, relevant authorities are going to develop and set out detailed technical rules and guidance to support the implementation of Genius Act, including how to prevent circumvention of the prohibition of interest. So my answer will depend on the effectiveness of these rules by authorities. And then second, if meaningful yield is achieved, I think it likely involves maturity transformation. This could undermine stablecoins' ability to maintain their promise to redeem at par on demand. And then finally, I would also add, in this context, stablecoins are really resemble or very similar to government MMFs. And then MMFs have established themselves as a popular retail investment instrument in many countries. Yet we don't talk about the end of deposit insurance as we know it. So let me stop here.
Thank you. There's a lot there to come back to, but let's hear from Michael Lee first.
Well, thank you for having me here. I'm a financial economist at the New York Fed, and I work on the intersection of technology and finance. The views expressed are mine, not necessarily that of the New York Fed or the Federal Reserve System. So, the US dollar stablecoin, we're at around 270 billion in market cap. And what's remarkable is that it's almost doubled in the last year. And so it's really useful for us to reflect on why this is the case. Key catalyst is regulatory clarity, or the promise of that. So it really starts with the executive order in January of this year that aims to position the US as a leader for blockchain-based technology. And I want to point out two important implications of it. First, it signals a preference from public to private innovation in the space of payments. How did it do that? Well, it bans central bank digital currencies, and it called for a regulatory framework for stablecoins. Second, it pivots the national stance towards blockchain-based innovation, and in particular, public blockchains. The rationale for that is that it wants to allow for individuals to exercise more control over their assets. And these two combined set the stone for how we have to think about the proposed changes in the regulatory climate. Now, the clearest momentum has been with the Genius Act and stablecoins. We have payment stablecoins, and there are three important characteristics. First, it has to be backed by safe assets. Second, provides par redemption. And third, it's banned from directly paying interest. And we got into a little bit of that earlier. We're going to come back to that. Now, the Act really envisions US dollar stablecoins as a payment asset that's distinct from deposits, securities, and national currency. And the simplest and probably the crudest but simplest way of thinking about it is essentially trying to replicate some form of digital cash, where individuals on a peer-to-peer basis can make these transfers and where it's actually fairly difficult to exactly monitor how this is being transferred across users, as long as they have been custodying that themselves. If we want to understand the impact and the implications of stablecoins, though, we really need to understand the functional and operational characteristics of how stablecoins look like and how the ecosystem may evolve. And probably the starting point is going to be comparing it to its close cousins, money market funds. So in terms of stablecoins, there in particular fiat-backed stablecoins, we need to focus on the offer for par redemption of tokens to US dollars and the way in which it manages a portfolio of safe assets, which actually results in liquidity mismatch, something that we know to understand is a feature and also a source of financial fragility, not just for stablecoins, money market funds, any type of money-like assets feature this mismatch between assets and liabilities that results in financial stability concerns. If we look at the reserves of payment stablecoins today, well, they're not yet compliant to even the sets of general standards set up by the Genius Act. They're holding 13% or so in non-compliant assets, including precious metals, corporate bonds, cryptocurrency. Luckily, we see that for US-based issuers, that's not the case. If you look at their reserves, their composition is eerily similar to government money funds. So that's a good thing. But there is a small caveat to that, which is the fact that 10% or so of their holdings are in bank deposits. And I want to come back to this because this is going to be one of the key issues that we need to think about in terms of how stablecoins might be more vulnerable or be a source of amplification even relative to government money funds. So I want to just emphasize kind of three components that we should look out for in terms of financial stability implications. The most obvious thing that we already see today is the level of concentration. We have two issuers that are responsible for 87% of the entire market. Now, we're going to see a lot of entrants from other parties, incumbents, and new players. But what we've seen so far from the experience of recent entrants, it's remarkably hard to build a foothold into this market. And that speaks to the basic issues with respect to network effects that are not only operative in stablecoins, but more generally in any type of network and any type of system where it benefits from having more users accept and use a particular type of asset or good. Second, if we think back to this financial stability risks, well, stablecoin issuers are already highly interconnected into our treasury markets and also with our banking system. Now, in terms of treasuries, as single entities, they're already large players. They hold over 2% of the treasury bills. That's a lot. And if we're projecting anywhere between 500 billion to the trillions, this is only going to get larger. Now, if we think about what leads to fluctuations in the quantity of stablecoins circulating, though, these are highly correlated with cryptocurrency market shocks. And so we see that the stablecoins will already act as the nexus of transmitting cryptocurrency shocks back to the traditional markets and lead to increased volatility exposure to more traditional financial systems and markets, such as the Treasury market and also the banking system. But let's go back to the banking system here. And I think this is where something really different is happening. If we take the example of Circle, well, they actually offer near real-time redemption of par to dollars. How do you actually facilitate near real-time redemption? Well, you have to have a bank account and a partner bank who's processing those payments on behalf of you through traditional financial rails, payment rails. So this actually introduces an additional source of intraday liquidity complications that are more unique to banks relative to what we are experienced with on money market funds. Money market funds typically offer T+1, T+0, which means that at the end of the day, they get to look at the inflows and outflows, net those transactions, and make the appropriate payments. That helps them with managing their portfolio, managing the liquidity composition of their assets, and also ensures that they can net transactions so that they can minimize the gross inflows and outflows. Now, the GES Act is very, very generally not providing a lot of guidance on how redemption is going to be offered, the potential standardization on that, the composition of these assets and what constitutes safe liquidity management. All these things are going to have to be sorted out. But what's clear is if we are envisioning payment stablecoins to offer better access to, let's say, par redemption and this in and out on and off ramps with US dollars, well, then we also know that it comes with a higher bar with respect to how they manage liquidity, how effectively that will be. But immediately what this means is that there will be immediate repercussions for banks, partner banks who are managing the reserves in the form of bank deposits in their accounts, and the potential fluctuations in the reserve balances that these banks will experience as a direct byproduct of providing payment services for stablecoins. This leads to some novel financial stability considerations that we have not yet kind of chartered out in our recent experiences with the money market fund industry and the financial stability considerations that came out of the global financial crisis.
Okay, those are great interventions to start with. I just want to a couple things for me. One of which.
Do I get to speak?
Hey.
Since Jeff is eager to move along, I will keep my comments brief.
Right. And from the UK, we now have, my apologies, Professor Judge. Go ahead.
No, I was going to say, I understand the desire to jump right in because we've already had such a rich conversation. And first of all, I do really want to thank Jeff and Todd, Daniela for putting this together. This has been a great conference. I really appreciate the structure where we're laying the groundwork, then talking specifically about the payment ecosystem, and now trying to take a step back and look at the bigger issues. And while I think Amanda nicely positioned herself as potentially the party pooper, I would actually say there's been a healthy tone of realism through many of the different conversations. It's certainly not the only tone that we have heard, but I think the questions with the use case and implementation and the amount of that we don't yet know and the potential disruptive effects and who's really making money here and what do their incentives look like, I think have been great issues that have really been integrated throughout this whole conversation. So I will keep my comments brief since Jeff seems to want to jump right in, but I do think there's a couple of things we haven't talked about that are worth mentioning, just building off of some things we said. I actually liked Michael just referring to this as something that's trying to create the digital equivalent of cash, because I actually think that depiction really speaks to Amanda's point that right now we have stablecoin issuers talking out of both sides of their mouth with respect to privacy and AML. And this is a key issue. Legally, the Act seeks to resolve some of this, some of it to rulemaking. But I think, as Amanda was alluding to, there's what the law says, and then there's what is the architecture of enforcement and supervision that actually mean you're bringing teeth to the law that is in place, and it's still imperfect for banks. And partly it's imperfect because we reward kind of the wrong things in the banking system. But that is what's adding a lot of the cost, particularly when we're talking about the cross-border transfers that everyone's talking about as being the site of so much of the potential upside and the potential gain. So it is worth kind of just keeping in mind how much right now the Act avoids some of those difficult issues. And those are really difficult issues. We have chosen to make the banking system and other types of financial institutions key mechanisms through which we implement law enforcement and foreign policy priorities. That comes with real costs, and people have very, very mixed feelings about that. I'd say there's a place for a very healthy public dialogue about how those trade-offs should occur and what they should look like and the privacy interests and other interests involved. And instead of having a healthy conversation, we're saying we're going to go ahead and like impose a lot of costs on certain sectors in ways that can be completely circumvented if you go around it through these other ways. And it's trying to level the playing field, and it says it's leveling the playing field upwards. But I think there's reasons that people are able to get away with talking about this as being different. And I think even the last panel and the focus on on-ramp and off-ramp and be able to close accounts is such a far cry from what it actually means to monitor activity in a risk-based way for suspicious transactions, given what you know about the profile. It's an ongoing process. And so I do think there's just a lot of open issues there. I'll also say, just because nobody else has, two other things since nobody else has raised them. I think there are other ways, going to the political economy point, that this legislation was rushed through and therefore chose to meaningfully dodge a lot of the key questions that really ought to have been answered by Congress and in the legislation. I think one place that's even more clear than AML is with respect to the question of master accounts. We have seen an ongoing fight because there's core legal uncertainty. Does the Federal Reserve System have the ability to deny depository institutions the ability to have access to a master account? And if so, are those decisions being made by individual reserve banks, which seems like a rather odd structure? The Fed has developed a practice of having very detailed guidance that's issued at the board level, implemented then by the reserve banks, but there's a whole bunch of different litigation, custodia and other suits kind of questioning, do they have that authority? And then also, what does it mean for these different bodies, these 12 different bodies across the country, to potentially be making these determinations in an individualized way? This is a source of legal ambiguity that's incredibly important to resolve generally. This was a key issue that should have been resolved in this legislation because banks that are involved in this space are among those that have really been at the kind of the precipice of the issue. And yet Congress intentionally said, we're not changing anything. Like there's there's these core legal uncertainties and we're not going to touch any of them. And so these are just like a couple of the ways that I think the legislation really tried to avoid doing what it ideally ought to have done, which is to have Congress. I mean, so even if you're going to legislate in space, but have Congress resolve some of the really difficult policy issues that come out of these types of developments. I love the fact we're having this conversation just because what we're doing here at core is facilitating and also legitimating a new type of money creation. That's the reason we're having this panel, and it seems too obvious to state, is new types of money creation oftentimes have the potential to be disruptive because they are meant to be assets that everybody trusts, where there's no questions asked. And once you have to ask questions, there can be runs and there can be significant spillover effects. And it tries to deal with that through kind of the bankruptcy provisions and through the asset limitations, but those are going to be imperfect. Like that's why we have the questions that we are about custodial issues, but also like how the overall infrastructure works. The fact that there was also so much uncertainty, it seems like even among members of Congress, between not understanding the difference between the issuer and the intermediaries, and for not understanding whether or not this would merely be a non-interest-bearing instrument that would be used, therefore, solely for transaction purposes, versus something that, from a consumer perspective, it might not be the issuer, it's the intermediary, but from a consumer perspective, is suddenly bearing interest, and therefore is a store of value that you're looking on in a particularly reliable way. So it is just kind of an overall interesting ecosystem. The last thing I'll mention, because nobody else has discussed it, are the aspirations of the Treasury market by the Treasury Secretary. I mean, so first of all, for anybody who hasn't been paying attention, Secretary Bessent is playing a very central role driving financial regulation in this administration. He has a clear vision of how financial regulation fits and can promote broader economic policy objectives. He's spoken very openly about this. And in connection here, I think they are very worried about how to fund this growing deficit. And there's particular reasons for concern, given an array of developments, as Jeff alluded to earlier, that the yield curve is not going to be favorable. And it's going to get less favorable over time. And so there really is this effort to issue a lot at the short end. And I think there was this desire to create a vehicle that would create demand. And we have a lot of historical precedent for this, right? I mean, so like, why do we have national banks? We only allowed states to issue bank charters after the demise of the second bank of the United States until we needed to fund the Civil War. And once we needed to fund the Civil War, we're like, all right, we'll grant bank charters, but then force you to buy up a bunch of Treasury bonds. We see the Fed and other financial regulators playing key roles, both forcing banks to buy bonds and forcing banks to make loans to others to buy bonds in World War I and World War II. Not forcing to, but effectively creating strong financial incentives to do so. So this is not something that's unprecedented. It's not just in the United States, it's been done elsewhere. I'm more skeptical that it's going to be successful here, but I think there could have been healthier conversation, again, about the way this might be being used to deal with a problem that is a growing problem, and it's a very significant problem, but perhaps ought to be addressed through other means. So there's a kind of a hodgepodge. I had other things I was going to say, but people have done such a great job covering them. But I think there's a lot here to discuss, because we really are talking about something that might not end up taking hold, but certainly has the potential to take hold in some significant ways. And it looks like there's a number of still open issues with respect to how it's going to be implemented and what the practical effects of even what Congress put into law were meant to do. Thank you.
Hey, thanks a lot. There is one other issue which you mentioned policy issues. One other large issue which I think ought to be put on the table and for the panelists to address, and perhaps others who know how stable coins will work. What would the proliferation of stable coins, both the Genius Act version and others that could come to arise throughout the world using the dollar, what would that do to the sanctions regime that the United States has used that depend upon banks as intermediaries with respect to very important foreign policy concerns of the United States and others? It seems like if stable coins are set up outside the official banking system and are used as a medium of exchange, as both a store of value and a medium of exchange, it would undercut the capacity to use the present payment system as part of foreign policy goals of the United States. I wonder if there's anybody on the panel who would want to take that one on. Yeah.
Unless someone else wants.
Amanda?
I would say this, importantly, the Genius Act for stablecoin issuers in the United States changes nothing, zero, regard to their AML or OFAC obligations. All of these companies already had state MSB licenses, and they had a very poor track record of complying. So they ought to have been complying. They weren't. The Trump administration put out a memo in April saying that they would no longer enforce the BSA against certain crypto companies just because of a policy preference. So I think that an argument made by sponsors of the legislation was that it was going to level up our ability to defend the perimeter of our sanctions and AML regime by applying this bill. But again, nothing in the bill changed existing legal obligations. They are already required to comply with OFAC, et cetera, et cetera. Poor compliance. And I will add, Coinbase in partnership with Circle funded a lawsuit in defense of Tornado Cash, which is a mixing service, which is just what it sounds like. You deposit your crypto in it, it spins it around and spits it back out in a way that's not identifiable, and got the Fifth Circuit to say that the relevant OFAC laws don't apply and that the Treasury Department was unable to sanction Tornado Cash Mixer as a prohibited address. So, I think crypto's here to stay. Chainalysis said it was the kingpin of illicit finance, and I don't really think that the bill changes anything in the near term because it doesn't change legal obligations, and we know what the enforcement regime looks like.
Let me add to that. So just to emphasize, if we look at the Genius Act, it really focuses on the issuer's relationship with direct counterparties. I think it's very clear that for that, they need to do their due diligence with respect to compliance to ensure that anyone they directly interact with, and that specifically pertains to issuance and redemption, that they need to make sure that they're not facilitating illegal activity. Now, having said that, I think there's a broader question about how we can amend the gap between some of the functional characteristics and even philosophy of these distributed systems that are intended to be censorship resistant with how stablecoin issuers and more broadly, the payment ecosystem that is built on top of stablecoins can address these issues. Tornado Cash is a good example where you can use it for anonymity features. It ended up being hugely facilitating North Korean hacked tokens in order to wash those tokens. But we also saw that there was, following the OFAC sanctions, that activity significantly declined. Is that evidence of compliance? It's hard to say. I think part of the challenge is because we don't know the identities of users, that the bar for how we can demonstrate some association with illegal activity or association with entities that we want to prevent activities of becomes challenging. Now, the third thing that I would mention with respect to stablecoins, which is tricky, is that by design, they're leveraging the fact that transactions on the blockchain could be immutable. And that means that some of the controls that they have is with respect to freezing or blocking accounts from further interacting with their token. Now, there are some discussions on what more functionalities they can build in, but that also means that without real-time checks on transfers, these tokens can travel very quickly. And after that, much like how we think about cash, once a criminal steals cash and uses it, it's challenging to actually claw that back. So there's some principles here that we need to think about with respect to the limitations for what we can revoke and what we can wind back when we move into from physical, and then kind of the conveniences of that the system has leveraged in the digital realm, and how we're maybe relinquishing some of that control as we move into permissionless blockchains that are enforcing these types of transactions to be set and final.
You want
I
to?
think they covered it. I think it's fine.
Yeah. Michael, one point you raised strikes me from a financial stability perspective is this. It seems like the easy redemption of stable coins in effect requires a lot of credit with a bank, because that's where the cash will be. And so the question is whether a run on stable coins or some other anomaly in the market that leads to a great demand for redemption could spill over into the official banking system in a way that would be of significant concern. As we saw, the GFC, there was a lot of folks grabbed bank liquidity, which meant that the banks couldn't lend to other actors in the real economy, and that increased the spiral. So to what extent do you think, in fact, the redeemability of stable coins in all states of the world will require liquidity at the banks that put stress on the banking system and or create demand for the master accounts of the Fed that Kate was referring to as potentially a troubling issue here?
So I think the start for stablecoin related shocks to affect the banking system, that doesn't require a run. So if you're seeing anywhere between 300 million to a billion in redemption requests at a daily frequency, and you're a major processor for a stablecoin issuer, and multiply that by X of how large the market will become, well, there are huge payment related needs in terms of liquidity that's going to continue to shock the system. Now, in the case of a run, I think that's where the first line of liquidity will come from the deposits. And then within cross day, within T+0 or T+1 will come from their repo holdings, which is 20 to 30% of their holdings. And then it goes to the treasury bill. So there are levels of how we can actually see the tolerance of how they can facilitate the liquidity. Now, having said that, I mentioned earlier, the redemption policies of stablecoin issuers are vast. They promise anywhere between 15 minutes to T+5 days of redemption. And so if you are a user and you expect par redemption and you go to them and they say, the circle is swirling and you're waiting and they tell you, okay, well, it's going to happen. Well, those are kind of the gray areas with respect to the expectations that investors might have that in terms of the services and quality of redemption that are really unclear in terms of standards. When we think back to the experience with money funds, though, we also know that these different types of policies can have implications for how they can resolve sudden and large demand for liquidity. And so these are things that need to be carefully thought through in terms of our learnings in the past and both in terms of standardization and the safeguards that would be appropriate in order for us to mitigate any of the payment-related shocks that are going to arise from the stablecoins back to the financial system.
So, final one before I turn it open.
I mean, on that point, this is Takeshi.
Yeah.
Can I
Hello?
come in?
Yeah, go ahead.
Yes, so I think the Michael pointed out very, very important point in my view. I think we tend to compare these stable coins to MMFs, but in my view, stable coins for payments, or especially for systemic payments, are really, really different from MMFs in that the stable coins require the timely redemption, possibly intraday, at least by the end of the day, unlike MMFs needing a T+1, T+2 redemption. And then this is really a high bar. And then, but without this the requirement, I think the stable coins used as a really a quasi payment system can really create the systemic risk. So that's why we, the CPMI USCO, when we issue the guidance, we are very clear about this very high bar for redemption, timely redemption. And then I lastly, because I'm looking at the clock, but I wanted to say, but having said this, but we CPMI is sort of a future oriented, and then also we want to understand how a central bank money, or central bank accounts, commercial bank money, and then non-bank money, including stable coins, can coexist, and how are they going to interact with each other in a safe manner. And then that's really an exciting topic. And then how to ensure so-called the singleness of money, so fungibility of money, so how we ensure with the new types of money, forms of money, tokenized or non-tokenized, non-bank money, so commercial bank money, how are they going to interact with each other? this is a really fascinating topic to the CPMI. So then, sorry, let me finish that here.
Okay, I think that's a great point for me to open it up for questions from the audience, and we have time for a few. I know lunch is, but anyway, so yeah, go ahead. Be sure to speak into the mic. So, yeah.
So I'd be curious about the panel's thought about how realistic Secretary of Defense's $2 trillion outstanding number really is. If you think global remittances are around 900 billion last year, and there's a velocity of that, so maybe that's a couple $100 billion of balance. If 100% of remittances were done in the form of stablecoin, and small balance deposits held by people for whom cheap payments might be useful, is maybe a couple $100 billion out of the 17 trillion of deposits. Very little of that deposits from small retail customers. That's only 600 billion beyond the 200 billion outstanding. So to get to 2 trillion, some big deep-pocketed corporation or high net worth person for whom the current system is really affordable, has to decide, oh, I'd rather use stable coins. So is that just not realistic, and Secretary of Defense's upside number is kind of a pipe dream? Or are there candidates for who that someone's going to actually get big corporations to start accepting stable coins and using them?
So I can start. I mean, again, so we've had extensive discussion with our rate strategy team when this number was put out, and they expect, and again, in a world where everyone's trying to figure this out, maybe over the next year or two, it's a couple $100 billion of incremental demand, right? To your point. So I don't think I have seen, and these are folks who are every single day thinking about the treasury market, and for them to come up with $1 trillion, forget about a $2 trillion sort of demand anytime soon, is extremely challenging. And it goes back to, and also what you're seeing is, we didn't talk about tokenization much, but right, you're seeing a lot of tokenization activity around money market funds are getting tokenized. So even and they are doing that for their own survival as they think about competing with stable coins. So I'd love to hear what the panelists have to say, but again, every conversation that I've had on the subject, it feels, I don't want to call it a pipe dream, but I think it's a little bit of a long shot right now as things stand around this, how much demand this will really create for incremental demand for treasury bills.
Can I jump in really, really quickly on that? Because I agree with that. And in case it wasn't clear earlier, I'm skeptical of the number and skeptical of the claims, but that doesn't mean the ambitions weren't there as part of the driving force. I mean, the other thing you have to keep in mind is like, where is the money coming from? And is that really coming from a place that is not already using T-bills? I mean, like money market mutual funds are a great example. Like there might be some people who are willing to make that move. There's reasons to question whether there will be, but even if there are, like a lot of those government funds are the ones that are right now holding a lot of the T-bills. So you're not creating net new demand. You're just changing the intermediary that's standing between the consumer and the Treasury Department.
And can I just add one thing? It's okay, Treasury bill demand may go up if stablecoin use goes up, if Amazon or something decides to create their own proprietary money. But are these stable holders of treasuries? Do we want them holding treasuries? And the thing I'm most concerned about is, if you are familiar with some of the largest stablecoin players in the market, firms like Tether, that was founded by a former Mighty Ducks child star, failed plastic surgeon, and the co-creator of Inspector Gadget. The government is going to get very beholden very quick to the owners of these treasuries, right? And what happens if there is a huge illicit finance scandal where billions of dollars is shown to be routed to North Korea? The stablecoin company is going to say, nice treasury market you have there. I wouldn't want anything to happen to it. So it's the interlinkages between what I would say are some of the most non-compliant corners of our financial system and the treasury market, and the kind of blessing and imprimatur of that is troubling to me about the political implications.
Other questions? Yeah.
I want to ask about, I don't think anyone's mentioned today, the government also passed a law.
Turn the mic,
forbidding-
we're transmitting.
Forbidding central bank digital currency. And I think that was partly because the crypto lobby wanted to have the market alter themselves with the Genius Act and stablecoin. Can some of the panel comment on, are there concerns with forbidding central bank digital currency? Should it be enabled? How will that change the dynamic with stablecoins if a future regime allows central bank digital currency?
Kate, do you want to take that one on?
Why not? I mean,
Currencies
I will say
versus.
the United States was not a leader when it came to central bank digital currency. I mean, Lil Brainard, I think, was meaningfully working on it when she was at the Fed. When she left the Fed, I don't think there was anybody in a senior position who had a lot of support or buy-in. That being said, central bank digital, first of all, a lot of the conversation today reminds me of the conversations around central bank digital currency. I mean, the use case and all these other questions were like what's been motivating a lot of that dialogue for a long time. The difference is other central banks are moving forward with central bank digital currency. And one of their rationales is the rationale we've heard today, which is cross-border. But if it's being done central bank to central bank versus central bank to private players, that looks very different. And so there is this interesting question, if the United States becomes an outlier, and one of the aims explicitly is about kind of facilitating cross-border activity, what that looks like. I think it's too early to say anything about that, but I do think it's interesting. The other quick note is I think that there was concern also about privacy animating that, and I think that is more of a reflection of how little understanding there currently is about how AML works and the type of information that gets made available through the current AML regime. So I think it was kind of also I mean, the Fed is not looking to provide a retail CBDC. It was going to be intermediated. And so there's little reasons to think that the information dynamic would have been all that much different than what it will be with these private issuers. And it's too bad there wasn't able to be a healthier conversation about there being trade-offs, but not necessarily trade-offs that lawmakers thought.
Okay, I think lunch is calling in a very intense way. Right? This has been a really very full day, and there's been a lot of new information and learning that's been put on the table. I think what the Richman Center wanted to do is at the very beginning of the academic year is to put before our audience the legislative agenda that has thus far been enacted in the Trump administration thus far. The Genius Act is one very important piece. And I think one of the lessons, the takeaways, is that we're kind of stage one of trying to figure out what it means and how the financial system, how the payment system will change, maybe not very fast or very far, how the financial system will change as a result, and that we'll come to know more as these things develop. The Richman Center also plans later in the fall to conduct a similar session on some of the healthcare changes in the one beautiful bill, and also to look further at the energy policy changes in that bill as well. So this is essentially stage one in our effort to explore some of the changes that are before us. But I think today was really a terrific day. Todd Baker really put it together, and bravo to him. It's rare for, a law school to be able to draw in such the expertise of folks who are actually in the front lines of this and are kind of giving us battlefield reports as a way, I think, of a change that is still sort of in medias res. And thank you all for coming. And lunch is outside the room. Thank you.
Thank you.